Thanks for clicking. CMHC is rewriting the rules of the first-time homebuyer incentive, also known as the Shared Equity Program, as the government attempts to limit its losses from Canada's slowing real estate market.
Get in line.
If you'll remember, the Shared Equity Program was introduced by the Trudeau government in 2019, offering matching down payments to first-time homebuyers by 5 or 10% depending on the purchase. However, with the government providing, say, 5% in matching funds, that also meant they maintained a 5% stake, 5% ownership in the property. The program proved massively unpopular as Canadians didn't like the idea of the government owning a share of their house, and as of December of 2021, only $253 million out of $1.25 billion available had been spent on the program. However, as interest rates have gone up and Canadian real estate prices have reversed, the government is now looking to cover itself. It's looking to limit its losses in the reversing real estate market. So what I want to do today is go over these new rule changes coming down from CMHC effective June 1st, discuss how these changes would play out in a real-life example, and then go over the implications of the government's backtracking for Canada's housing market.
Now I got to turn my back.
The Bank of Canada just raised interest rates by 50 basis points, bringing the policy rate up to 1.5%, and there are already murmurings from the bank that they could go as high as 3%, depending on the inflation rate. We'll obviously have updates out on Bank of Canada policy and our inflation rate on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into the CMHC reversal. As mentioned, the Shared Equity Program from the government offered matching funds for down payments for first-time homebuyers, but also gave the government a share in the property. So if you bought a house for $100,000 and you put $5,000 down and the government put $5,000 down, the government owned 5% of the property. So if the house went up in value to say $200,000, the government would be owed their 5%. They would get $10,000.
You don't mind if I take my taste now?
However, with Canada's real estate market shifting, with prices continuing to reverse, CMHC is now worried about its downside risk and potential losses from its investments. Under the new rules, effective June 1st, the maximum amount of appreciation that the government will take is 8%. So if your house appreciates over and above 8% per year, anything over that 8% you get to keep. For buyers who've already paid the government back, they can apply for reimbursement. However, and this is the important part, the maximum amount of depreciation that the government will take is also 8%. So how would this work in real time? How would the government's maximum amount of depreciation of 8% work with a current home devaluation? Let's take a look at the example we spoke about earlier with the $100,000 house and the government owning a 5% stake. Now say that house depreciates down to $80,000. So we've had a $20,000 loss on that $100,000. The government would only lose 8% of its 5% stake. So despite the 20% loss on the value of the house, the government is only going to lose 8% of its initial investment, so $400. So if you went to sell the house, the government would still be owed $4,600, a $600 difference than had the government stuck with the initial rules. So under the initial rules, the government would have lost $1,000, 5% of that $20,000 loss. Under these new rules, the government is limiting its losses to 8% of its investment, so 8% of that $5,000 that it initially invested. In its article, the Financial Post noted that the government is getting increasingly worried about reversing home values in Canada.
We're in it together, huh?
And about further reversing values in the future. The government number crunchers and political analysts likely realize that the price risk is real. They're not stupid. While these new rule changes and the shared loss inherent in them only apply to shared equity programs used after June 1st, I think the amendments to the program have real implications for the future of Canada's real estate market. CMHC and the government have access to a lot more data than we do on our real estate market, on the Bank of Canada, and how their policies will affect prices in the future. And I think the government looking to limit its losses in Canada's real estate market doesn't show a whole lot of confidence in the stability of our prices. Time will tell how much of a correction we are in for. In my hometown of London, Ontario, we've lost about $80,000 to $90,000 just since February. So obviously these interest rates are having a major effect on home prices, and interest rates are set to continue to go up. As we mentioned, the Bank of Canada is already talking about raising rates to 3%. Doubling the policy rate from right now, and we've already seen major losses all across Canada's real estate market. With the government already hoping to limit its potential losses going forward, Definitely not a great sign for Canada's home prices, and we'll definitely have to see how this plays out in the future with the rate hikes coming down the pipe more and more. We'll obviously have updates on Canada's real estate market. We're expecting more data in from the local boards within the next couple days. Click like and subscribe if you want to get those updates, and thanks so much for watching.